Welcome to the Jon Sanchez Show on Newstalk 780 KOH. It's such a pleasure to be with you, and a great pleasure to be with one of my two normal co-hosts, Mr. Cory Edge of Edge Realty. How you doing, Big C?
I'm doing fantastic. How are you?
Very well, thank you. It's almost
Love
Friday.
it.
It's almost Friday.
Yes. Just a,
You and I just get to sit here and talk for the next hour. How about that?
just a few hours away from Friday, if
There
you
you
count
go.
12:01. Yeah.
Exactly. Mr. Millard had a function that he had to attend to. So again, Cory and I will be flying the ship, as the saying goes. Spaceship, that is. All right, let me tell you what we have lined up for you. We, of course, will go through today's stock market activity. Nice little recovery today. Finally, we get a good day where actually all four of the major averages did pretty well overall, considering everything that we're facing. And then we're going to get into a very interesting topic we haven't discussed in quite some time: the power of the 1031 tax deferred exchange. So here's the scenario, folks. Many of you may know of this and many of you may not. And this, again, I want to tell you right from the beginning, we are not CPAs. Cory is a real estate broker. I am not. But whenever we talk about tax strategies when it comes to real estate, again, always make sure you run it past your attorney, your CPA, so on and so forth, because the rules are very, very in-depth, and obviously we don't have time to get through them. But we both do them. Matter of fact, I'm right in the middle of one for a client right now. What if I told you there's a legal way to sell an investment property, pocket your profits, a zero tax as far as capital gains, a zero depreciation recapture, that little hidden 25% tax I always remind people of? Well, at least pay for, at least now, for now, you're not paying those taxes. Okay? It's called the 1031 tax deferred exchange. And it's really one of the most powerful wealth building tools when it comes to real estate. So what Cory and I are going to do this afternoon is we're going to reveal how smart investors utilize 1031 tax deferred exchanges to, again, postpone. You're not getting out of the capital gains tax or the depreciation recapture tax, but what you are doing is you're postponing it. And you see, folks, there's this great thing called the compounding effect of money, right? Albert Einstein said it's the eighth wonder of the world. So imagine if you're selling an investment property for $500,000, and if you didn't do a 1031 tax deferred exchange, I don't know, Cory, let's say, I don't know, maybe you owed $200,000 in tax on it, right? So now you're netting $300,000. Do a tax deferred exchange, as you're going to find out when we go over the rules. You have to buy an investment property, like kind transfer of equal or greater value. That means you need to put it into another investment property or something similar investment wise, $500,000 or more. But now you've got $500,000 working for you in this new real estate venture versus, say, $300,000. So imagine the compounding effect over time, having that additional $200,000 in this example. That, again, is one of the powers of a tax deferred exchange at 1031. So you may not need it right now in your life, but at some point, if you ever look to sell a piece of your investment real estate, guess what? Or sell a property in your investment real estate portfolio. This is a strategy you want to kind of keep in your back pocket and, again, decide at that point if it's worth it. Now, sometimes, of course, you run across situations where you're like, you know what? I'm sure you've had this, Cory. I know I have had with clients. I'll tell them about a 1031 tax deferred exchange. They're like, you know what? Appreciate you telling me, but I'm just going to pay the taxes and I need to profit the money and, put it in my pocket and go on and do something else. A lot of times they just want to get out of real estate altogether. But Cory, I absolutely love this topic. And again, you and I both know how powerful it is. Like I said, you and I have utilized it with our clients. What's your opinion on it right out of the gate?
I think it works in a lot of situations. It doesn't work in every single situation, but it does work in a lot of them. One of the things I always run across, I'm sure you do too, is as soon as you bring up this topic, they're like, well, my house is worth X, and can I do? I'm like, no, investment property only.
Yes.
Usually that same client is holding their house in an LLC because they don't understand liability and all the other stuff. So investment property only. And as you mentioned, if it's a long-term play, if that was the game plan from day one, and for whatever reason, you're going to sell that property, but it's always been long-term that money and that capital that has grown will stay in investment property, then of course this is a no-brainer to do. I've had clients over the years, I'm sure you have too, when they move their base of operations, a lot of times they'll transfer their properties to their base of operations for whatever reason. Or if they hear like, hey, Reno's really hot, prices are high, but that market's a little depressed, I'm going to roll the dice, sell over here, get into this market while it's depressed with a 1031 exchange and see if that market can make a run. So
Absolutely.
all different ways to
And
do
kind of
it.
hopscotch across the country and do it.
Sure.
Yeah.
Absolutely. Yep.
Yeah. No, and again, and it's not, folks. It's really not a complicated topic. I mean, like anything, you can really delve deep into the rules. We're going to, of course, kind of give you the 10,000 foot view of it, but the bottom line is, like I said, it's not a complicated situation. The one I'm working on right now with my client Corey is he sold an investment property with a very low cost basis, like $25,000 down in California, and got a great offer to sell it. Didn't want to be a landlord anymore. And so when you imagine what the capital gains tax would have been in California, because in
Yep.
California, because remember, folks, in some states like California, you got to pay not only the federal capital gains tax, but also a state capital gains tax. Now we don't have obviously the state capital gains tax here in Nevada, but it saved him a lot of money. And we're going into a product that is a institutional level portfolio. He didn't want to go. He didn't want to be a landlord again. He didn't want to go into another investment property, but we have a product again where you can pool your money with other investors and leave it up to institutional managers to go pick the property. We're doing a really interesting one, Corey. We're going into student housing, which I know is one of your favorites, at Oklahoma University. How's that?
Nice. Hey, their football team's doing
I
well.
looked over the deal and I got kind of your blessing on it. First thing that I did is, part of my due diligence, I asked Corey and I said, Corey, what do we have here locally? He's like, Jon, there's not much for that amount of money, and so on and so forth. So we used a structured product, and yeah, and very interesting. So I'm dusting the cobwebs, Corey, off of the 1031 strategies, having to go through all the paperwork with him.
Oh yeah, it's there. We'll get into intermediaries in different way, but I like the fact that you said it's really not. It sounds a lot more complicated than it is, as long as you have a good third party, which is called an intermediary, which we'll get into.
QI.
If you get a good, honest intermediary, they make the whole process incredibly simple for you.
Right. Yes, you're absolutely right. So we'll teach you how all this strategy works. But first, let's get down to the stock market side of things. Not a significant amount of things to really talk to you about it. Like I said, it was a good, solid session today. We finished up 144 on the Dow, gained 201 on the Nasdaq, and higher by 38 on the 39 on the S&P 500. Sluggish a little bit out of the gate today. We had Tesla's numbers come in after the close yesterday, as we discussed on the program. Started to kick into high gear a little bit. Stock finished up decently, $10.12, 2.31% to 449.09. It had a loss of nearly 4% earlier in the day, as I said, but obviously came back. Las Vegas Sands was a real strong performer today, up 12.39%. Again, after a very strong earnings report there, predominantly out of the Macau operations. Stock up $6.27, 56.89. Nvidia higher by $1.88, 1.04% at 182.16. We saw a little bit of action going on in the semiconductor arena. Honeywell was our star performer of the Dow today. You usually don't see the stock move like this, Corey. Dow component, as I said, $14.06 gained, up 6.81% to 220.67. Again, strong earnings report, and also raised their guidance. Dow component, or the company Dow, up 13%. So what we're seeing, folks, is we're seeing a nice rotation, right? It's not just, I'm not telling you, we're seeing all these major tech names just doing very, very well. We're seeing this nice rotation, right? The old true names, the Honeywells, the Dows, those type of things, they're starting to really attract a lot of investor money, and that's nice to see that rotation. Probably the other highlight today is we had some comments out of the president overnight in regards to quantum computing, right? Which Jason and I have discussed a bit. This is kind of the next level of computing and so on and so forth. And he said, we're interested in taking a stake in some of these companies. So we saw a huge run up in these. Rigetti Computer today up 12.31%, $4.43 gain to 40.49. Q, 9.36% gain. Quantum Computing, that's the actual name of the company, 10.7% rise, so on and so forth. So that area was really hot, and that, of course, helped out the NASDAQ. Also, speaking of the president, he said he's going to meet with President Xi, of course, the president of China, October the 30th, to discuss a potential deal covering soybeans, rare earth metals, nuclear weapons, and that little tiny company called TikTok. He noted that he doesn't want China to face the threats of 157% tariffs, calling them unsustainable. So he's going over there, Corey, with a lot of expectation that he's going to get a lot of deals done. Again, we're talking soybeans and all the different things that I've mentioned. So we'll see if that happens. But that talk, again, eased the pressure a little bit here at home. Other than that, like I said, it was a relatively quiet day today. Now, Corey, guess what? We actually get one economic report tomorrow. We haven't had one in the whole entire government shutdown.
Yeah.
Now they they called the BLS workers back to the shop, and we're going to have us a CPI report tomorrow. So we'll see what that number transpires into and what kind of impact in the market. So I'll be covering that, of course, tomorrow morning. It'll be out at 5:30. So we'll see what happens there. But anything else you're seeing right now? Any impact real estate wise with the government shutdown? Anything along those lines from a macro standpoint?
I haven't heard too much about ill effects of the government shutdown. I'm sure it's happening here locally. It just hasn't, there's not enough of the FHA and USDA loans that would rock the market. It's just kind of as Dwight would mention, the rates are good. The buyers seem okay. The market's just, it's not slow, but it's not fast either, right? It's just kind of trudging along, heading into wintertime. I'm still getting a lot of open house things and price reductions, and it's trying to find its place, right?
Right, right. Good, good, good. Speaking of that, we will bring you up to date. Let me get a fresh quote for you where we close that today. Since Dwight's not here, we'll tell you what the 30-year mortgage did, according to Mortgage News Daily. And it was up 1 basis point today on the 10-year at a yield close of 6.18. So I think that's right where it was on Tuesday, Corey, if I remember
Yep.
right. And
Yep.
15-year, 5.74%, also up 1 basis point for the day. And the 30-year FHA, I know Dwight's been talking a lot about these, 5.91%, and the 30-year VA, 5.93%. So I like seeing those sub-6 numbers. We just need to get that 30-year below sub-6, and I think that'll help things out a lot. All right, you're now up to date on the market. Again, no economic report, so that shrinks down the time that we have to talk about the market. Let's move things over to the real estate side when we come back. The power of the 1031 tax-deferred exchange. Corey and I will cover with you, but first let's turn it over to Kristen Snow. She is in the Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Corey Edge of Edge Realty. Dwight has the afternoon off. Once again, we finished with a gain of 144 on the Dow, a rise of 201 on the NASDAQ, and higher by 39 on the S&P 500. All right, before we get to our topic, the power of the 1031 tax deferred exchange, here's the commodity side. Man, oh man, did we see a big run up in oil prices today. $3.27 gain, 61.78 a barrel. Once again, the president yesterday announcing sanctions against some very large Russian oil producers. So that's why we saw this national concern about oil prices rising. The traders bid it up. Good day for gold. Finally, a comeback here. $80.80 rise, $4,146.50 an ounce, and up 4 basis points on the 10-year at a yield of 3.99%. All right, once again, we're going to now get into our topic, the power of the 1031 tax deferred exchange. So as we described at the first segment, if you just joined us, let me tell you what this is. Okay, so first and foremost, again, if you are ever going to consider 1031 tax deferred exchange, make sure you get your attorney involved, make sure you get your CPA involved, etc. There's a lot of team members that need to be involved when you decide to do this. But if it fits in your situation, it can be a very powerful force, right? There are some downsides to it like anything else, and we're going to lay out the pros and the cons to it. But first of all, what is it? Where does this 1031 come from? Well, that's the tax code. And what it says is this section of the IRS tax code says that investors in investment property, and again, you cannot do this. Let me repeat, you cannot do this with your primary residence. But if you have investment property, you can transfer that property, so one investment property, and reinvest the proceeds into another like kind property. And the goal behind this whole thing is you're deferring the capital gains. You're not eliminating them, but you're deferring them. Now, there is one way that you can eliminate them, but you're not going to like the answer when I tell you what that one is, and we'll get to that momentarily. But the goal is you want to defer. So you want to go from one property to another, to another, to another, and therefore never pay capital gains tax until, now I might as well tell you, until you die. And Corey will go through what happens when you die. You get your estate gets a stepped up basis, and that wipes out all the capital gains tax if you sell, in the very quickly after your death, and the price does not go up for your heirs. But Corey, let's bring this down to our second point, which is, why does this matter? Why do we want to even consider a tax deferred exchange when it comes to our investment property?
As you mentioned in the beginning of the show, and you go back to the compounding interest and even the Warren Buffett, like, it doesn't all just have to be stocks, but at any time that you can save and preserve your capital and keep that capital working for you long term, it's going to compound, hopefully, the returns over time. And so if instead of paying Uncle Sam, to your example, the $100,000 or 200,000, whatever it was, if we can keep that working for another 10, 12, 20 years, whatever you want to call it, it I don't want to say it gooses the returns, but it helps the returns along versus taking the tax.
Right, exactly. And once again, the key, of course, as you'll find out here, you have to buy something of equal or greater value. Now, let's go to our third point, Cory, which is the eligible properties, because this is where you need somebody of experience. Again, one of the team members called a qualified intermediary, or a QI as we call them. They can help you with this along with your CPA, etc. So a lot of people think that if you, let's say, for example, you have a single family rental and you want to do a 1031 tax deferred exchange, that you have to buy another single family rental. And that's not the case, Cory. You can go to like kind properties, which is you can actually go from a single family rental to a commercial lot or to a commercial building. Expand on that.
Correct, like kind. So in the world of real estate, think of like kind as anything most of the time real estate related. Raw land, commercial properties, multifamily properties, trailer parks, really all the stuff that we've talked about on the show over the years, the different types of real estate investments, most of them are going to be like kind. If you get into a different kind of ownership structure, that's where you want to make sure the intermediary may be able to help, but the tax accountant is the main person that'll be able to say, well, I don't know about that, because one of the things that everybody has to remember on these, let's say you and I own a property and it's Jon Cory LLC. Well, if we want to do a 1031 exchange and Jon Cory LLC sells the property, Jon Cory LLC has to purchase the new property. So Jon and Cory got to be on the same page, because if one wants one thing and the other one wants another, the 1031 may not work. There are very complex 1031 ways to make that work in a partnership, but things have to be set up. I would say, I'm not an accountant, but I would say at least a year, maybe 2 years ahead of the sale to make sure that it goes the right way. But for the main point, whatever entity is selling is the same entity with all the players that has to be buying.
Absolutely. And it also, well, we'll talk about if you have some debt on the property also, because that clouds the waters a little bit. So we'll touch on that in just a second. Okay, so like kind properties, again, big misconception. You got to go single family rental, not the case. And I should mention also, and we're not going to get into it today, but you can also do 1031 tax deferred exchanges with businesses, right? So if you have a business that you want to sell, and again, you have a capital gain that you normally would be assessed because the business has gone up in value and whatever all the assets, etc. You can also talk to your accountant about doing a 1031 tax deferred exchange for that also. But again, a whole nother topic. So now let's go back to the real estate side. Okay, now let's go to point number 4. Now, as I said at the beginning, there are a lot of rules that you need to follow, and very stringent rules. There's no, geez, I'm sorry I missed that deadline. Please forgive me, IRS, that type of thing. There are very, very stringent rules. And the first rule that we want to mention is the 45-180 rule. Cory, go right ahead.
So from the time we sell, again, let's use the example that you want to sell your property. Say, Cory, I want to sell it. We're going to do this. I'm really interested in this 1031 exchange. You need to let your broker know ahead of time before you sell the property that this is what you're thinking of doing, because that broker then has to go out and say, okay, we need to go find stuff or start looking at other things, because the clock, the 45-day and the 180-day rule, which I'll get into, that clock starts ticking the minute the property that you already own closes escrow. It's called the relinquished property. So from that relinquished date, the date you close escrow on that property you already own, you have 45 days to identify in writing on the forms up to 3 other properties that you are going to purchase. And then from that day, you have 180 days back to the relinquishment time, 180 days from the time that original property sold to close escrow on one of those properties. You don't have to buy all 3, but you have to close escrow on one of those. And if during that time, the time between the 45 days and the 180, if you change your mind, tough. You haven't identified the other property, you can't buy it. A lot of times when I do these, we want to, if possible, identify and close within the 45 days, because I've had clients before that have gone out and identified in 45 days, don't get around to closing, and by the time they try to, they haven't even written a contract. Those properties are sold. Now you're SOL, excuse my language. There's all these little nuances in it too. If you identify more than 3 properties, you have to close on every property you've identified. So you got to be careful on
You can go to a
how you
maximum
do.
of 5, correct?
You can close on as many as you want as long as it
Well,
takes.
no,
But
as
if
far
you,
as identifying, isn't it 5 the maximum?
I don't know if I've never seen, maybe it is. I've always kept it at 3 and under,
Yeah.
knowing
Okay.
that if I go 3, knowing that if I go 4 or more, Now we've got to buy all of them, otherwise the whole thing gets blown up. But I've never looked at the amount that you could max identify, if you will.
And let's
So,
clear. I'm sorry. Go ahead and finish.
no, I was just going to say, so two very important dates: 45 days from the close of escrow of the property you're selling, and 180 days from close of escrow of the property you're selling.
Yes, exactly. And what I was going to say, Cory, those are calendar days. It's not working or business days. It doesn't matter if there's holidays. It's pure calendar days. So those are your two critical deadlines. And as I said, going into this point, you can't go to your. We'll talk about when we come back from the break. The other member of the team that has to be involved in a 1031 called a qualified intermediary, you can't go crying the blues to them, say, hey, I was on vacation, I forgot about the 45 days or the 180 or anything like that. So there is no forgiving on that, or you could blow the entire 1031 tax deferred exchange. So very critical. 45, 180. Those are the two main time periods you need to remember. When we come back, we're going to go to point number 5, which is we're talking about the team members. So you have your real estate agent on one side or both sides of the deal. As Cory said, just to reiterate, you have to let that agent know you want to do a 1031. Now, Cory, I remember in the old days, you as the real estate professional would have to check a box in the on the MLS listing or the sales contract, excuse me, indicating you were going to do a 1031. Is that still the case where you have to
So,
physically put it? No. Okay. I
well,
thought that
no,
had changed.
no, you do have to disclose it, but our current contracts have it already written in there. There's not even a
Okay.
box.
No
It's
longer you have
just
to put it in.
in the
Okay.
body of it.
Okay. Very good. Yes, and we've had that happen before. I've had people, and I'm sure you have, Cory. People, they're getting real close to escrow, like a couple days, and they're going, hey, well, you know what? Matter of fact, I had one a couple years ago, literally 2 days away from escrow, and he calls up and he goes, hey, I want to do this 1031 exchange into this package product, and I'm like, when are you closing? He goes, oh, in 2 days, and through grace of luck, he was able to go back and talk to the seller and or talk to the buyer, and they were able to maneuver some dates, and he was able to get it done. But you don't want to be putting everybody into that situation, right? So let everybody know right up front. So you've got the real estate professionals, both sides or one side. You have normal escrow, right? Looks and smells just like a normal escrow. But again, you have to notify escrow you're going to do a 1031. Why? Because when we come back, there's a third party that's involved called a QI, better known as a qualified intermediary. We'll explain what their role is in the 1031 tax deferred exchange process. All right, let's turn it over to Jack Saban. He's got news, traffic, and weather. Back to the Jon Sanchez Show on News Talk CKOH, joined by Cory Edge of Edge Realty. Dwight has the afternoon off. Once again, we finished with a gain of 1 from the Dow, up 201 on the NASDAQ, and higher by 39 on the S&P 500. All right, we're helping you with some real estate strategies, right? The tax deferred strategies, better known as the 1031 tax deferred exchange. All right, let's recap what we've touched on so far, Cory. What is it? Well, once again, 1031 is the IRS code that allows investors, again, this is only investment property, to sell one investment property and reinvest the proceeds into another like kind property, thereby deferring the capital gains. And Cory, you and I know this is a pet peeve for both of us. I find even CPAs forget to tell their clients when they're talking about tax strategies when it comes to investment real estate. I call it, it's my own little term, it's no official term, the gotcha tax, the depreciation recapture tax, right? How many times do people come back and go, oh my God, I sold my property and, I did I knew what my capital gains was, but then I got hit with this depreciation recapture tax, right? It's just always forgotten. Don't you agree?
Well, and it's so funny because I get clients, I'm sure you do too, and they're like, I owe 200, it's worth 500, so I should get a check for 300,000 when it's done, and then I'll get to do whatever I want with it.
Right.
I think you're forgetting a few things here,
Just
like
a few things.
the
Yeah,
federal
just a few things.
government and all the other
That's
stuff. Yeah.
right. That's right.
So
State and federal. And
talk to
remember,
the
folks,
accountants.
yep, we've got to change to the capital gains rules, or rates, I should say, starting next year. So make sure if you're going to do this in 2026, you check with your accountant on the rules, because remember, it's not just a flat 20%. It's actually, if you make, and again, whole another subject, below a certain amount, whether you're single or joint, you could actually have a zero capital gains tax. So that's why it's very important to talk with your accountant before you do this, because a lot of times you may fall into, say, the 10% capital gains tax, and then you kind of go, do I really want to mess with doing a 1031, or do I just want to pay 10% capital gains tax and have that capital to go do whatever you want? So don't think, this is another misconception, don't think you're always just going to pay a flat 20%. For those in higher income brackets, guess what, you get to add on about another 3.3%, Cory, so you can be up to 0.3% capital gains tax. Again, if you're doing this in a state, and Cory, while talking about a state, let's give our listeners a little bit of a warning because obviously we both have clients in California. People always think that California, or they don't realize California has a their own capital gains tax. I believe that one, if I remember correctly, I didn't look it up before the show, but I think maybe 5.5%. I think is the max California capital gains tax. I can look it up the next break, but I think it's right around that 5% mark.
Yeah, I try to stay away, so I have no idea what it is
Okay.
because I don't want to know what it is.
Yeah, yeah, and then yeah, a whole nother set of rules. Then they can actually withhold some of your proceeds to
Hmm.
send it to the IRS ahead of time, and so on and so forth. So again, what is a 1031 tax deferred exchange? And you're again deferring your capital gains tax as well as your depreciation recapture tax. And I should explain what is depreciation recapture. So when you have a rental property, you've hopefully your accountant has depreciated that asset over the life. Where are we at, Cory? 29 and a half years, right, on
Sure.
investment
Yep.
property? Commercial 39, 35, 39 and a half, somewhere around there. It's a little bit more, a little longer depreciation schedule. But anyways, they depreciate it. Plus some of the furniture and fixtures, meaning that's not really the correct word. Some of the infrastructure of the property, they've depreciated. So so they got to come back and go, okay, Cory, you wrote off of depreciation over the 20 years you've owned this property. Guess what? You get to pay a 25% tax. It's not usually on that full 100,000 in this example, but a good portion of that. Bottom line, a lot of people forget about it. And again, I've had many accountants completely forget to tell their clients, and it's a big shock come tax time. So just be careful about that one. All right. So that's what it is. Why it matters. Again, we want to be able to take as much money as we can when we sell an investment property and move it into another property so that we have more money working for us instead of losing money to taxes. We've talked about the eligible property, again, like things like rental homes, commercial properties, land, even vacation rentals. If it's income producing, you got to be really careful on the vacation rental one. And then lastly, we touched on the 45-180 rule, which is, again, from the day that property closes, you have 45 days to identify up to 3 properties. If you get into some of the package products, you can actually go, I was wrong. It's not up to 5 properties to identify. It's actually an unlimited amount as long as it does not exceed 200% of the sales price of your property that you just sold. So again, that's a whole nother rule there under what we call these package products. But 45 days to identify up to 3 properties and 180 days to close. No ifs, ands, or buts about it. And then lastly, before we went to break, we said, okay, you got a lot of team members, right? You got your CPA, you may get an attorney involved with it. You have your real estate professionals, you have your escrow company. Wow, there's already 4 people right there. Now, who's the 5th one? A QI or a qualified intermediary. Cory, let's go down this path.
So in the world of a 1031 exchange, the qualified intermediary is the most important person. Not that they'll give you some general advice on the structure. They're not accountants, they're not this or that. They're going to tell you to go see your lawyer or your accountant if you have specific questions. But one of the most important things, and I get this, I guess I haven't had this in quite a while. I'm sure you've gotten it too. People will call and say, "Hey, I just sold my property. I'm interested in a 1031 exchange. Can you explain to me?" Like, if you sold the property already, it's too late. It's over. As soon as that title is done and it's sold, the clock has already run. And so, what the intermediary, and you have to use an intermediary, what the intermediary is going to do, and the reason the little blurb is in our sales contracts, is they are basically going to get assigned the rights of that contract. You still have title companies, you still have all those, but in the eyes of the IRS, the intermediary is the one that makes sure that you don't have what they call constructive receipt of the funds. The money that you're making off of the relinquishment or the sale of that property can never touch your bank account. You can't use it for anything. It has to go into the qualified intermediary through the contract assignment, and then they will turn around and buy the new property via contract assignment with those funds. You don't touch it. You can't. The minute you touch that money, it's over. You're paying taxes whether you like it or not.
Exactly.
And
So let's
so
go
they
through.
are, oh, go ahead.
No, go ahead and finish.
I was just going to say, so they are the most, at least in the eyes of a 1031 exchange, they are the most
Yeah.
important person in the transaction.
And be careful who you select. There are some kind of fly-by-night QIs out there. I stick with some of the big names. A lot of the right, Cory. A lot of the reputable escrow companies have a QI division.
So what I would say, I won't stay on my soapbox too long, but here in Reno, there's a couple smaller companies that have been doing this forever. You can look up their references. You can tell how long they've been in business. Anybody that it's a very weird deal because they're kind of quasi licensed, but not as much as you would think. There was an instance a few years ago, which is kind of now blown up, but still ongoing, where some local scammers were doing, believe it or not, hundreds of millions of dollars of these things. They had set up their own intermediary. And when the whole thing blew up, the money was gone, all gone. And people had exchanged into other properties and they weren't legitimate exchanges because the intermediary wasn't legitimate. And I don't know what's happened with those sales, John, but I was told by a couple of attorneys the IRS will come in and unwind those. You will pay tax on that,
Sure.
even if you had no idea
Yep.
you got scammed. So
Okay.
stick with the reputable companies.
Yes, indeed. Yes, indeed. Okay, so let's real quickly before we go to break, let's give you a quick example. So I sell an investment property for say $500,000. I want to do a 1031 tax deferred exchange. Corey's marked it on the contract. We're all good. Corey then fills out a identification form saying, here's the three properties Jon is identifying for his 1031 exchange. Corey then, as my real estate agent, links me up with a qualified intermediary. Escrow closes. Let's say it's the 1st of October. Escrow closes. That $500,000 does not go from my title company to me. Again, as Corey said, I cannot touch one penny of it. So what they do, escrow then wires the money to the QI. Okay, so the QI has the money. Some of them will pay interest, some of them won't. So that's something you want to ask about. Now we fast forward, and Corey finds my next property. I find another rental property I want to buy for say $600,000. So no problem. Corey then closes that transaction on the sale price for the $600,000. He notifies the QI. The QI then wires the money to the new escrow company, or maybe it's the same as the first one, but wires the money to the escrow company, and then it's done. You will get tax reporting, from the QI as well as your escrow company. So you do get it 1099s, and there's some certain tax forms that have to be filed. That's why you want to get your CPA involved with it. But it's really, from that standpoint, it's really simple, right, Corey?
Yeah, it all happens behind the scenes. And without getting too complicated, in the middle of all of this, your sale agreement on the property you're selling will get assigned to the intermediary. When you go to buy a property, that purchase agreement will get assigned to the intermediary. So that's how they're able to help sell, hold the cash, and help purchase. And it's again, it's all required to make one of these things work correctly. And it's at the end of the day to make sure that you don't touch the money. And then when they're done, they're done. They charge a fee, obviously. It's worth every penny. It blows my mind that people will save hundreds of thousands of dollars, but they will find the cheapest QI they can, in the yellow pages because they don't want to spend $5 extra.
That's right.
So
That's right.
go go with the reputable people.
Yep. And last point, then we got to run real late here. Let's say we sold that property for 500,000, but actually, let's do a different number. Let's say Corey sold the property for 550,000, but with his commission and various escrow fees, etc., the net proceeds are 500,000. That's what I have to 1031 exchange, the 500,000. I don't have to do it on the 550,000. Right, Corey?
Correct. And you got to go up in debt as well. If you had debt on there, you got to
Yeah,
go up in
that's
debt.
a whole nother issue.
Yep.
It gets really tricky there. All right, we
Yep.
got a few more points in the 1031 tax deferred exchange strategy. Let's wrap it up with Kristen Snow in the Right Now Traffic Center. Kristen, welcome back to the Jon Sanchez Show on News Talk 780 KOH. Mr. Edge, your phone number, sir. Beautiful. All right, and let me dig up Mr. Millard's phone number. I should have had that all ready to go. 775, of course, 240-2022. You think I'd have that one memorized? All right, we're talking about the 1031 tax deferred exchange. Now, let's continue down our points, Corey, see if we can get this wrapped up. Now, you mentioned this incredible, nasty word called boot. Not a boot in the butt, but it kind of is in a sense. Number 6, we want to avoid boot. What is boot? That is any cash or debt relief that you receive during the exchange, which becomes taxable, and you don't want it. Explain, Corey.
Correct. Yeah. So you can, if you sell something for 500,000, the rule is you got to spend 501,000. And if we won't get into it, but if you have debt, then you got to go up in debt. If for some reason you're like, you know what, I only want to spend 400,000, I'm going to keep 100,000. You can still do that, but you're going to get taxed on the 100,000 clearly. And also with debt, we won't go into all the details, but you have to go up in debt. If that property was carrying 100,000 in debt, you got to go 101,000 in debt, or 100 and a penny, I guess you can call it. If you go backwards, the difference you went backwards could be considered boot, and you would get taxed on it.
There you go.
The QI will help you with those. They'll give you the numbers, but a CPA will help you with different strategies if you're not sure what those numbers should be, if that makes sense.
Exactly. Great point. Okay, number 7. We touched on this. We can just kind of skip over this. You got to trade up, not down. Again, sell a property for 500. You got to get something worth more than 500,000. Leveraging strategy, I think, is our 8th point, Corey. Use the tons to move from active management like single rentals to passive income, family, multifamily, commercials, some of these package products and things like that. And that's where we sit with our clients, right? They're just tired of being landlords. They don't want to do it anymore. They don't even, not that they have any problem with real estate. They just don't want to be that landlord anymore. So again, going into institutional package products, multifamilies, things like that with a property manager, it just seems to fit that new stage of their life.
Correct. And to clarify, like when we were talking about in the beginning, if you have a single family rental, but you can go pick up a fourplex for this and still make the numbers work, you can do that. You can also go from multiple single family rentals into a big building. You can go from a big building into multiple single family rentals. So they're all like kind, just depends how much.
And even dirt. Don't forget dirt.
And even dirt, yeah. And so you can go any way you want. And to this point, if you have a bunch of properties and they're kind of a headache, yeah, you could go into one building, it's one manager, it's one roof, it's all these things that might make your life easier if you have it all figured out.
Absolutely. All right. Last one, the legacy planning. Again, when you inherit the property, you're meaning your heirs, when they inherit the property, you get a stepped up basis that wipes out all of these tax deferred gains. So you could have done, whatever, 5, 10, 30 different tax deferred exchanges over your life. You pass away, and maybe your original cost basis was 100. Now it's 10 million value of your real estate. Guess what? All those taxes, they're all wiped out. But unfortunately, you got to die to do that. So most common mistakes, you miss deadlines, you choose the wrong intermediary, you mix personal and investment property. Just don't do that. Talk to your team, assemble a great team, and hopefully the 1031 works out well for you. It's a great strategy, Corey. Thanks for bringing it to our attention.
Absolutely. Keep good records.
Absolutely. All right. God bless everybody. We'll be back with you tomorrow on the Jon Sanchez Show. Have a great afternoon.